All right, ladies and gentlemen, we are back on the daily live stream with Capital Flows. We have just me today. James is, like I said yesterday, gallivanting in the great American outdoors. And there's a lot of stuff that we're going to cover today. I think that there's a lot of changes with the CPI print this morning. If you're trying to understand how to think through that a little bit, we actually covered it yesterday. And one of the things that I laid out was you're probably going to see hedges unwind. There's limited downside in ZT. And, maybe bonds can move around a little bit. But on net, are we going to price more than 50 bips of cuts this year? Very unlikely. And guess what? We have CPI come out. We have Warsh come and float some different ideas across the tape that we're going to cover today. And all in all, what happens? We have equities bid. Bitcoin is bidding on the day. Apparently, crypto Twitter is alive because all they do is move with the price action because there's nothing else happening besides Bitcoin price action. With that being said, there's going to be some even larger, I would say, catalysts, not only in the AI market, but also in the entire derivative space, that if you are not watching these and understanding these and beginning to integrate them into your framework, in 2 weeks' time, there's going to be some pretty big changes, and I'm going to cover all of them today, that you really want to be on the right side of, and at the very least, aware of the implications around them. So if you are here, throw something in the chat. I just want to make sure the audio and everything else is working, and then make sure this is good to go. I said in the chat, if I actually, and I'm sorry, I totally forgot yesterday, or I think the day before, I was like, oh, if we get someone first in the chat, then there will be, we'll get them a subscription on the Substack. I totally forgot about that. What we will do is, if you were first in the chat, shoot me a DM on Twitter. And let me see. A lot of good questions already. Frank, I need you to be earlier. This is unacceptable. Let's see. Excellent. Sounds good. Okay. Well, before we jump into the slide deck for today and the topics that we have to cover on the AI arms race between the US and China, which, by the way, this is probably one of the first times in history that we have a technological retooling of the economy at the same time two countries are in active economic warfare with each other. I know that, historically we've had situations where, people are connected, but on net, we haven't really seen this level of integration on a globalized basis for US globalization. So if you're watching this, retweet it on Twitter, and I want to cover several things to start off everything. The first one is that if you're here, everything will be laid out. Everything that you get here will be laid out on capitalflowsresearch.com. Everything will be really clear. And then also, right here, the recent tweet that I put up is this big announcement with the CME and single stock futures. And there is, I think we have about 50 contracts that, let's see. My mic is picking up my typing. Well, welcome to my world. Frank, I expect you to be earlier. And if you are earlier, then I will answer your questions. But I just have higher expectations of you. I know you can do so much more. If you're wondering about any of the trades or stuff like that, we covered them all in the live stream yesterday. Okay. So nothing has changed in my positions or my views or anything like that. When you look at the macro economy overall, we are seeing two consistent themes, and this frames everything. One, liquidity is expanding. And how do we know that? Well, the largest liquidity impulse is getting channeled into one place, and that is the AI trade. IPOs in the AI trade function like FOMC catalysts. I actually just posted this. People clearly don't get that these IPOs are literally like FOMC clearing events for the AI trade. So this is the tweet that I've just put up because the SK Hynix stock, which just had its IPO, we have ADRs, this is all coming out. By the way, is setting lows and highs in the entire AI trade right now. We had Cerberus come out and set a high in Nvidia. SK Hynix came out and what? It set a low in Nvidia, like literally to the day. Why? Because these catalysts set the highs and lows for everything. This is why when you look at Nvidia right now, it's bidding and it's probably going to keep bidding. And this all comes back down to stacking the macro regime with the changes in positioning, with sector flows, with rotation, with everything else. And that's the entire goal that we have and that I really have for capital flows. You know, my goal is I really want this live stream to be basically the biggest financial live stream in the world. And how are we going to accomplish that? Basically, I'm going to provide so many amazing models and analysis and reports for all of you guys to break down the macro regime for risk takers and the opportunities within that, that it really is able to provide such a comprehensive picture of every single thing. And if we have that, then I know it's going to provide value for everyone and it'll be a very helpful tool that adds value to each of you guys, wherever you guys are in your journey of macro markets and everything else. So everything is big for active risk takers and people who are trying to navigate recession risk, inflation shocks. If you're trying to understand the inflation shock that's happening right now, that's what we're going to cover today. And want a clear view on rates, FX, and US equities. This entire section in this week is focused on US exceptionalism and the US exceptionalism trade. And the reason I'm focusing on that is because right now, I actually just watched this interview with Alex Karp this morning, who I think has, been doing a great job at Palantir. The great thing about Alex Karp is every single person either absolutely loves him or absolutely hates him. And, I think he just has such a kind of clearly depicted view of the world. And he's actually called out these larger AI frontier labs like Sam Altman, Dario, everyone at OpenAI, Anthropic, and things like that, because these guys are coming out and they're trying to shape the thought process around the labor market, the AI trade. They're trying to shape everything. And what you have to recognize is that these guys are actively trying to do that for their own purposes. And so, the whole goal of the live stream is to break down the fundamental principles for things like that and then connect them to global capital markets, macro liquidity, the credit cycle, and everything. And then if you are brand new here and just trying to figure out everything, everything is laid out at capitalflowsresearch.com. The first part of the live stream will be free, streamed onto Twitter and YouTube. And then the second part will be the private member section, only streamed on Substack, which you have to be a paid subscriber to be able to go through everything. And you can get all of that below. But before we jump in to the ideas today, I talked about this winner-take-all effect in the AI arms race between the US and China, because this is really the environment that we are in right now, the winner-take-all effect. And if you are watching that, you can know that here's just the tweet that I did the other day. One of the things that we covered today in the live stream, this was a couple, I believe a week ago, which you guys go over. If you want my entire view on interest rates and everything setting up into CPI, which this is still a very relevant live stream, you need to go watch this right here. I just retweeted it so you can go through it yourself. But the macro environment with CPI and with these macro forces with Warsh is interacting with, it's one force, and it's beginning to push up against this AI trade. And the AI trade is shifting because it was NVIDIA. and then it went to Micron, and then now it's pushing a lot of money into on the day today the SK Hynix trade and IPO, and these changes are really setting tops and bottoms in the U.S. equity market. Just look at how you know I'll put Cerebras Systems right here. This will just show you how much all of these IPOs really determine things. What happened is Cerebras Systems had their IPO, and what did that do? That set a top at Nvidia, and we've traded down since then, but we've held the overall larger macro regime. And during this time right here, when Nvidia was kind of pulling back, what was taking place? You had a lot of changes in the entire memory space where you had a rotation into MU, and that began to take more. Now, notice right here when Nvidia sets up, you know what? Sorry, I need to switch screens. Right here, you can see. Let me just make sure this is up. All right, you can see Cerebras setting the top, coming down, moving all the way here. And then you have this rotation out of NVIDIA into MU. And now you have NVIDIA setting a bit of a bottom. It's coming off, and people are rotating back into NVIDIA. The reason why you want to understand these different changes is because everyone's extrapolating each of these changes on a idiosyncratic basis to the entire system. They're saying, oh, NVIDIA is selling off, so the AI trade has to be over, even though all you're doing is seeing a rotation from chips to memory. And this is really where we connect rotation in equity markets to larger macro forces, for example, like CPI on the day to day. And once you map both of those and stack the edges for both of them, then you can begin to understand why things are taking place, how they work, and all of the factors around them. So, again, if you guys are here, I'm watching the chat. If you guys have any questions, throw them in the chat because we're going to be covering them. And then I'm going to make sure. Oh, hang on one second. Hang on, I just need to adjust this really fast. All right, we're good to go. We're good to go. So let's go over what we just saw with the CPI print on the day today. And that is that we have what I laid out the other day. Let me pull up the tweet that there is limited downside in ZT right now and ES. Why did I say there's limited downside in ZT and ES? And those are just the future contracts by the CME group that are directly linked. They're basically the most liquid contracts in the world that everyone trades for all these changes. So here's what I said the other day. Equities have primarily pulled back when interest rates rise marginally over the last month. This means understanding rates is critical to mapping equity beta. As it stands, there is a limited downside in ZT, which is the CME futures contract, as we approach and move into CPI and the July FOMC. The long end can move around marginally, but any pullbacks in equities driven by downside in bonds are likely to be short-term in nature. Let me explain what exactly that means. When we're talking about macro changes in the underlying market, the place that you want to start are the changes in interest rates. This is the ZT contract. If you are one of the guys who trades interest rates, it's going to, I would say overall, once you spend time understanding interest rates and understanding how to trade them, it's going to be one of the in a sense, like life-changing things because it gives you so much more clarity about every other thing taking place in the economy. But here's the idea that I laid out. I said, listen, we are moving into the CPI print. And what happened? We have this kind of level right here that we, sold off a little bit in ZT, sold off a little bit again, and we have been in this overall range. Then into the CPI print, what happened yesterday? You had oil spike a little bit, which caused some adjustment in bonds. And then what happened? The CPI print came out today, and the CPI print showed, kind of in lockstep with what we've been talking about, is that more cuts are unlikely to be priced between now and the July FOMC meeting. If you're, looking at the July meeting, let me just pull this up really fast in the dashboard that I have. Here is a breakdown of the July meeting. So right here, you have the Fed Fund FFN6 contract, which if you want to look at that on TradingView, you just go ZQN and it'll pull it up. But notice that now we're pricing an 82% probability of a hold. So we just went from a coin flip or a probability of a hike to basically the market saying like, no, we're not going to hike in July. It's probably not going to happen. So that on the margin is moving things around. Notice that back here in ZT, now that that is taking place, what begins to reverberate across the curve? You have now bonds bidding a little bit and holding these levels. And notice right here, this goes back to what I've been talking about on the S&P 500 and ES, is that these pullbacks in ES have, a lot of them have been driven by inflation risk. So you can notice right here that on a year-to-date basis, bonds have sold off and bonds are down. I believe year-to-date, bonds are definitely down year-to-date. They're down. The ZN contract is down 3%. So if you want to watch bonds, don't watch the ETFs. Watch either the outright interest rates or the futures. The futures are the most important thing to watch. And what you will notice right here is that this is us selling off on the geopolitical risk. Bonds are selling off, stocks are selling off. Then we rebound, just adjusting positioning. But what did we say during this period of time? That stocks are likely to outperform bonds. And what began to take place? Bonds sold off. Why? Because inflation risk is making its way through the system. And stocks bid because there isn't recession or macro risk for equities. And on top of that, the AI trade is just getting warmed up. And there are risks under the surface. And those risks are primarily connected to how some of these AI labs are trying to float these different ideas and how that connects to China. But on net, on a macro basis, what we are seeing is capital move out the risk curve. This is, very typical of the environment that we're in, where the carry trade is pushing a lot of capital out, and you're having a lot of changes where the S&P 500 has the greatest exposure to the AI trade. It's all tech. Just going over a couple questions here on okay, good question here from Mr. Krabs. Does a country, not the US, yield curve, does a country's yield curve, specifically the 2s, have as much of an impact on the currency in other countries, just like the US has on its own? So that's a great question. And we're going to cover the yield curve actually a little bit more in the paid subscriber section today. But what I would say is that the yield, your view of a currency, should always take into account and net out against the yield curve. Because a yield curve, all we're doing with a yield curve is pricing the risk-free rate across time, which can be impacted by credit risk or duration risk. If you're trying to understand the difference between those, there's actually an entire section on the Capital Flows Research website that goes over all of that. If you go to capitalflowsresearch.com, click on this main page right here, you can go through this video and see everything that is here. If you scroll down, there's an entire educational primer section right here, and this breaks down all of the ideas with credit risk and duration risk. I'll actually grab the specific one that you want to go through. And let me pull this up right here. So credit risk and duration risk in this macro alpha primer basically breaks down all of these factors. I'm going to throw this in the chat right here. You guys can go over it yourself. It was published on August 17th, 2024. And let me just post it again. Let's see. Okay, so I just posted this so that you guys can go over it. I just posted it on Twitter so you guys can go through it yourself. But let me pull this up. The idea that I would really give to everyone on how I think about macro and the AI trade right now, and as it relates to credit risk and duration risk and interest rates and everything, is that you want your macro view to correctly net out across everything. So what does that mean? It means that you want to say, okay, how does the AI trade impact US equities? How does the US and China impact US equities? And how do all those factors move together? So, again, with the SK Hynix IPO, the idea there is that this is one of the many catalysts that is reflecting the environment we're in, which is one of excess liquidity. There is a lot of liquidity in the market right now. This is the tweet that I shared that people clearly, I was saying don't understand, because a lot of people are saying, oh, liquidity is contracting. There's issues because the yield curve is flattening a little bit or stuff like that. And again, those people are clearly not trading equity beta or correctly mapping equity beta to that, because what's happening? IPOs are coming out. IPOs don't come out in a contracting liquidity market. They could set tops, but they can also basically be along the entire way for the IPO for a credit cycle melt up. And let me just actually pull up a chart, and I'll show you this exact idea, because this entire idea of IPOs is critical to understand, because it is. Oh yeah, this is so good. Hang on one second. Oh, hang on one second. I just need to pull up this chart, and you guys will see the value of IPOs coming out is pretty insane right now. Okay, so this is the IPO chart for the values for the value of IPOs getting launched. This 2020 and 2021, it's showing that we are in, 2021 was a credit cycle melt up. It was one of the largest liquidity impulses we've ever seen in US history. And I'm actually going to post this right now, this chart, so you guys can go over it. Okay, I just posted this chart, and you can go on the my Twitter right here and go through. You can grab this exact chart, and if you guys can retweet that just so the other people are aware of it, that would be super helpful. But when I think about the environment that we're in, it's clear to me that there is such an excess of liquidity in the market that people in the private markets see that and are taking advantage of it. So just think about why someone even wants to go IPO. It's because they can get better terms for raising capital and get such a significant premium than they can in the private markets. And that's one of the reasons. But another reason is just the amount of capital. But there's so much capital in the private space today that people want that liquidity premium. And so the idea here is that we are seeing a convergence of macro forces where there's excess liquidity in the market. And then you see it converging with the AI trade, which is what? Now you're seeing AI companies take advantage of this and go IPO, and those IPOs are directly connected to this entire environment of macro liquidity. So these are all very connected flows. These are not separate flows. And so this goes back to the other idea that I had that I shared recently, where I talked about this idea of, do you want to decrease inequality, have China revalue its currency higher, and stop suppressing it for economic warfare? People are mad at the billionaire class when the real culprit is blatantly malicious acts by China. A lot of people didn't really like this tweet because at the end of the day, it is getting at the heart of something that people would rather not ask questions about. If you think about the environment that we're in, it is so much easier to demonize the billionaire class. And part of that comes from that the billionaire class has social media now, so it's so just in your face. It's so blatant. But when you begin to understand that, I think it goes back to this idea, actually, financial advisors think about this idea all the time, which is why they don't ever go to cash, which is, people usually look at other people in a bull market and they just want to be outperforming, right? They say like, oh, well, I'm okay, doing, whatever, investing in whatever way, as long as I'm up more than that guy. Because think about it. If you have your portfolio and the S&P's up 12% and you're up 15%, that's pretty good. You're outperforming the S&P, especially if you don't have a tax liability. That's amazing. But think about it. If your friend comes to you or some other neighbor, that one guy that you're always competing with, I don't know what you guys are competing with these days. I don't know what people are doing out there, honestly. But that one guy that people don't like, and he's like, "Oh, I'm up 20 or 30% because of this, this, and this." Well, immediately you're like, "Oh, well, I don't want to be in that situation." And you're like, even if you're like, "Oh, well, I think there's going to be a bear market or something like that," just that relative comparison is something that would cause people to take more risk. And then on the flip side, when the S&P is down, the financial advisors will say like, oh, well, yeah, it's down, but we're not as bad as these people, right? Or down as bad as this fund or this situation. And it just goes back to that, the entire game that we're in today, people are just comparing against one another. And now when you have kind of the billionaire class really in your face on social media, that's an amazing thing, by the way, in one sense, because you get to learn from them. I mean, in the past, they were just, you never got to hear from them at all. And now you get to see them making content, and you can take it for what it's worth. I think on net, it's a positive if you take it the right way. But most people don't want to take it the right way. But going back to this original idea on China, how does this connect to the AI trade? How does this connect to the macro liquidity environment, the CPI print this morning, everything? We're going to pull all that together. But the idea here is that inequality in the United States is primarily because real wages and incomes have been suppressed for a long period of time. Well, why is that? People are going to focus on inflation, and that inflation is the thing that is driving it, and that we just need to fix fiat. But again, most people don't really understand fiat because, if you had inflation in the past, a lot of times incomes would move with inflation. So what you need to ask is not, oh, is inflation good or bad for the consumer? What you need to ask is, why aren't wages moving with inflation? This is so much bigger than, inflation, or people that talk about gold or Bitcoin, or the idea of like, oh, if we fix fiat, we'll fix the system. It's not really the case. It's just misdirection. When you look at what is actually causing the currency to do what it's doing, right? For years, we had the dollar lose value and the middle class wasn't carved out. And so that thing alone should make you ask, okay, wait, why is that? Why is it that the dollar lost value during periods of time, but the middle class wasn't hollowed out? Right? I mean, we've been off the gold standard for a while. That's not the issue. Trust me, you don't want to be on the gold standard. It's like a horrible way to have economic growth, horrible way to have all of these things. And the the net effect of the inequality that exists is like, yeah, it causes issues in society, but the source of it is related to China and their economic warfare and the dollar's reserve currency status. So right now, China and the dollar's reserve currency status are two sides to the coin. And that is the entire idea that I laid out in this video yesterday, the American exceptionalism trade. If you haven't watched this video, go watch this video, because I explained the entire thing with China, how it connects, why it matters, and all of the metrics behind that. If you want to decrease inequality in the United States, and what I would do is, if you are saying like, oh, I want to understand how this works, or I'd love for someone else to comment on this, just tag them in this tweet and say like, oh, hey, how does this work? Is it true that if we actually just rebalance the trade against China, change the dollar's reserve currency status a little bit so we don't have all the negative effects of it, that would change the inequality situation, instead of blaming it on the money supply or anything like that? I mean, even if you actually look at government spending as a percentage of GDP and the deficit and things like that, a lot of that is connected to the entire capital account that we have with the world right now and the dollar's reserve currency status. So all these things are very connected. If you understand interest rates, you understand all that. This is not a secret to the universe. It's actually well documented if you do the research. The problem is, it's not this like really sexy story that demonizes someone in the United States. It is actually, really draws attention to the fact that, these are part of global economic flows. And there's a reason why we have the inequality that we have today. Now, with that being said, technology has increased, and this is now the greatest time to be alive. This is why we're talking about US exceptionalism today. This is why tomorrow we're going to have an entire live stream on that entire idea of US exceptionalism, especially as it connects to defense spending, which we're going to talk about even more. And if you begin to stack these bets, where I'm saying, okay, what's the macro environment? How should we think about that? What's the biggest trade right now for the AI space? All the flows of capital are going to that. All right, what's the next trade that's likely to take place? And in my view, that is going to be US defense spending, because that's already popping off. And that's really the key for all these flows. And if you're going to say like, oh, I don't know, man, this doesn't really make sense. All of this is just the data. If you go through the entire slide deck that I shared in this video right here, everything is very clear if you just go through the actual data. And people like to pontificate or go over that like, oh, the actual problem is this government spending, or this politician, or this or whatever, the entitlements, the Social Security, whatever it might be, right? But if you actually go and understand the supply of dollars that gets pushed to that, the actual not just the symptom, but the underlying cause and root cause of the system, then you'll begin to understand how global capital flows work. And again, that's why understanding interest rates and all these things actually has an edge in markets. So the overall system has been, not set up by any specific person, but has, occurred where you have to actively now, with the technological changes we have and with all the liquidity in the market, you have to actively take risk in the market, or as an entrepreneur, or as someone who is getting equity. That's why I just posted this tweet about the CME group and how they're now launching single stock futures, which in my view is going to be one of the biggest kind of things in the kind of financialization system that is beginning to take place. Because once you begin to have these types of futures get launched on single name equities, there's going to be so many benefits that begin to occur and play out. And if you're watching this, this is the tweet that I just shared on this. The ability to trade single stock futures is going to be massive. This will change a lot of hedging flows, overnight risk, and geopolitical risk pricing. I'm going to be on I already signed up for this event by the CME, and I would encourage everyone to go there as well. I trade CME products; it's the majority of everything that I trade, and the the event that they have is going to break down these futures. And I would encourage you to go to that event, sign up, be there. And once these futures get launched, it's going to allow a lot more capital efficiency in the system, and it's going to allow a lot more leverage. People say like, "Oh, that's a bad thing." Well, you can call it whatever you want. Leverage in the system on net gets abused sometimes, but on net, it allows people to take risk in a more nuanced and precise way, because you can use your capital more efficiently, especially for speculators, especially when there's a lot of liquidity in the market. And liquidity provision and speculators overall provide a very important service to the market, which is liquidity as a service. So you have all these different kind of things that, you have the people in corporations that are providing goods and services in financial markets. There is liquidity that is provided, which is a service. That's why you need to understand liquidity and money, because in itself, it is a service that you are providing. There are premiums and discounts in markets if you quantify them correctly. And these products are going to be a pretty significant evolution for them. And so, it's especially going back to, capital efficiency, and then also taxes and everything else. The single stock futures are going to be I think, a really big kind of progression in derivatives, because you're able to get a ton of leverage, not put up a ton of capital, and you're able to, get that leverage by not just buying the underlying stock, but you're able to do it through the futures market and through a derivative, so that you don't have to have, for a single stock, you have to put up a lot more margin, right? So if I buy a stock, I have to put a certain amount of margin up. When I buy a futures and a derivative, that allows me to have the same exposure with putting up less capital. And it allows me to use my capital more efficiently. And so there's going to be a lot of, I already put all the tickers for all the names here. Um, especially when short squeezes happen, when geopolitical risk gets priced in, there's names like Intel, JP Morgan, you have MasterCard, Meta, MU. I mean, think about Micron. That is going to be a really fun stock to trade, because there's going to be so much opportunity when you have a futures market for it. All the volume is going to get pushed through there. And then what you're going to have is overnight risk that changes, and you'll be able to trade that on an overnight basis. You'll be able to trade AMD, Amazon, Broadcom, Bank of America. You'll have Boeing, all of these big names, Caterpillar. Again, all these are very significant names. And then you also have, Oracle, Palo Alto. You have the Palantir, Qualcomm, Starbucks. I don't love their coffee, but I'll be happy to short their stock on futures. But for, we have SpaceX, Tesla, You have Visa coming, Verizon, Walmart, XOM. So when you have all of these new products coming out, these are all going to be very significant for the ability to express risk. And one of the things that I would say is that once you have the ability to, run these types of trades, it's going to really increase the, in my view, it's going to increase the hedging flows through all of this. Because let's say you have, a lot of overnight risk, right? That people are trying to act on if there's some geopolitical event or something like that. Well, now, previously you can trade, ES or any of these other, futures for ES and Q or anything along those lines, RTY, YM, the Nikkei. You can trade all of these, right? And you can trade them against each other. But think about it. The dispersion that takes place overnight where, yeah, the S&P is up, but which parts of it are up? Which elements are higher and lower? And one of the main trades that quant funds or large hedge funds or stuff like that do in markets are the changes in dispersion or breadth or things like that. And so the idea here is that there's a lot of opportunity for that. So if you guys have any questions about this, I'm more than happy to kind of chat about it. If you guys are in the chat and you guys want to go over anything specific, please kind of throw it in there. I'm more than happy to talk about it. Um, if you guys have any questions about any of the trades that I'm running, I covered them all yesterday in the live stream, and I covered them all yesterday in the report, and nothing has changed on my views if you guys are wondering or anything like that. Again, if you guys want to spend time going through each of those ideas, they're all laid out. So if you're a free subscriber on the Substack, you get all the updates every day. So I mean, you have to go and just like actually read the updates. That's how it works. So in the market overall, what I would encourage people to do is, be aware of these CME contracts that are coming out. I think they're going to be really significant. And then here's the one thing I'll say about the CME contracts and why it matters. On the CME side, and these new single stock future contracts, I I strongly believe there is going to be a day in the future where this AI trade it gets overdone. All right, we already have the highest valuations in history. I actually just did a post about this, retweeting Brad Setzer's thing, which is really good. If China won't revalue its currency higher, other countries will try to revalue their currencies lower. That's what we're seeing right now. There's a reason why the yen is down so much because governments are trying to rebalance their trade and cross border flows so that it has more of a real purchasing power change. This is why it's very tough to understand some of these flows because they're on a real purchasing power basis, not nominal. And so, you can say, okay, well, this price is going up or down in nominal terms, but sometimes it's hard to see how that works when you're ordering things from other countries. And so if China won't revalue its currency higher, other countries will try to revalue their currency lower, hence higher gold prices. I'm bullish gold here. They will inflate the bubble further, which is why equity valuations across the world, not just in AI, are the highest in human history. This is, probably the most significant fact of today that I think people are misunderstanding, which is that I'm going to pull up the chart really fast. The Here we go. The overall system as a whole has the highest valuations in history right now. And that's not just because of the AI trade. The AI trade is part of it, but it's not the entire picture. Because, and let me pull this up. Just notice, and I'll show you a bunch of different charts on this, so you can kind of begin to really get a picture of like, oh, this is not just about the AI trade; it's about a lot of other things as well. If you look at the Nikkei, if you look at the DAX, if you look at Euro stocks, everything, the price to sales ratio of those names are the highest they have been in history. If you go to, let me pull this up. Here we go. All right, so here's the Russell. What you can see is that we're back at 2021 levels for the Russell. That's pretty significant because the Russell is, all the small caps, and the fact that we're back at all-time highs in valuations, not the price, in valuations is really significant for small caps. It just shows you this entire move of valuation expansion is not just about the AI trade because all the AI names are in the S&P right now. And then you look at something like the Nikkei, which, by the way, probably the most misunderstood market right now that's impacting everything. I've covered this many times. The Nikkei is at the most historic extreme it's been basically since the 70s and 80s bubble in Japan in its valuation. This is the price to sales ratio for valuations. So this shows the standard deviation of price to sales ratios for the Nikkei. So this is not just price, it's the valuation of it. And this is how overextended we are. Now, valuation in its own, on its own, is not a market timing signal. If you try to use valuation to time things, you're going to be very disappointed because valuations is only one part of really the pie. And so when we go to pull this over, let's see here. When we come back to ideas like this, where we have these IPO values, this is the value of IPOs getting launched. When you have these beginning to increase, and you have equity valuations the highest they've ever been in history, and a lot of that is connected to this dynamic with China because it won't revalue its currency higher, and it creates an excess of dollar liquidity in the system. And again, these are all just reflected in the flow of funds data. Net foreign investment in the United States, which means that foreign investors buying U.S. equities at the highest it's ever been in history. Right? These are just the pieces of data that we have about why equity valuations are high. They're all connected to the currency. It's all connected to interest rates. It's not just about inflation. It's so much larger than that. So this is why when I talk about, okay, well, if valuations are high, people could say, oh, it's only connected to the AI trade. Well, if that were true, it would only be in certain stocks that valuations are high, which is not the case. Actually, in many ways, the valuations in a lot of the AI stocks is lower than the broad market, depending on how you adjust for it and how you're looking at it, because they have so much earnings that are accelerating. This kind of connects to the idea that I want to bring us to for what we're going to cover today, which is all on the, let me pull this up, the China trade between the US and China on the AI arms race. And this is what I'm going to begin to walk through, where I want to be able to have a clear framework and lay out a clear framework to be able to trade the US-China AI race as a supply chain, not just the narrative stories that come out. And again, this is building on yesterday's stream. And what you want to do is watch yesterday's stream, watch today's stream. If you don't know where any of that is, just go on to the website at capitalflowsresearch.com. Everything is laid out here. You can go through all the articles, the American exceptionalism trade, that's really key. And everything is laid out there. You get all the research every single day, and then paid subscribers get the proprietary report that I lay out, breaking everything down further. All right. So let's dig into this. AI is a winner-take-all effect. There is no prize in the AI space for second place. The entire US book is positioned for first. This is, I think, an important starting point because a lot of people, I think, believe that they're not only in the frontier labs, but also I think in this overall space where they say like, oh, well, there's going to be a lot of room for everyone. Everyone will be able to just adapt and change a little bit. There's an element of truth to that. I think that there is going to be a lot of different niches that evolve. But what you can see already in this battle between OpenAI and Anthropic is that OpenAI lost market share incredibly fast. That means that, and I think that idea of the largest depending on how you're defining it, but largest AI lab basically getting flipped by Anthropic within a 6 month period of time, which is just a massive thing. It was so fast in how it happened, which I think is just going to be accelerate even more. What makes you think more disruption in the economy and everything else is not going to happen just as fast? Now, with that being said, I think that the AI labs overall are now facing this question about the models that are coming out of China, which are now open source. There's a lot more benefits to using open source versus the frontier labs because of the data layer and all these other things. And also, this is really where I think there's risks in markets because China recognizes that they flood the market with cheaper models that are open source, so you don't have to just give them your data, and have the cheaper prices, cheaper token costs. That people are going to leave Claude, leave OpenAI, and OpenAI and Anthropic are going to start making less money, and then they're going to have to either pull on the U.S. government, which we're already seeing Sam Altman do, or they're going to have to IPO into a situation where it's not very optimal, right? They're going to have to IPO when their cash flows are not in the best place that they want to be. Companies when they want to go IPO, they do that because they are in a position where everything's kind of perfect for it. And so everything is really getting connected to these two IPOs. I think that if they have an opportunity, OpenAI and Anthropic, if they go IPO, they should just. I mean, if they have the opportunity right now, I think they should just do it. Again, I don't have any insider knowledge or anything like that on where they're at with everything, but given the amount of liquidity that we have in markets right now, and all of us know that the run rate for OpenAI and Anthropic is decreasing. I mean, they're not doing. They have a wall coming where they're going to have to raise more capital, and in let's say 6 or 12 months, you might not have the amount of liquidity you have in markets right now. But Sam Altman would probably say like, oh well, if he was being honest, he would say, oh well, we're not at the place fundamentally where we would really be able to attract the amount of capital that we want. And you just say like, okay, well, you might be able to get to a better place in 6 months, but by that time the liquidity in markets might not be the same, and that could cause a massive issue for you. And this this really connects to. I'm actually going to pull up a chart of. We've already drawn the parallel to 2021, not only in the valuations for the Russell, but also in the IPO market, which is taking place. We have the IPO market's popping off just like 2021 right now. We don't have SPACs and stuff like that, but what I will say is that we have volume going through Polymarket and Kalshi. We also have a lot of larger changes taking place where there's a lot of money in the system that is getting spent, and it's representative of a surplus of money in the system. Now, think about it. In 2021, what was the main thing that people were talking about and putting money into? Bitcoin and Web3, crypto projects, and things like that. Here is really the concern that I have that's beginning to build. The largest IPO that took place in 2021 era was the Coinbase IPO. They were basically the biggest player, especially inside the United States and everything else that's happened. The IPO here, I mean, granted, we took a little while because we had this double top in Bitcoin, which was actually connected to real rates in the yield curve and the currency, which is why you want to really monitor those really carefully. But going back to the idea of the IPO, the alpha in the market was all centered around Web3 and crypto. Part of it was the monetary debasement that was taking place that was directly involved by the Fed. The Fed isn't doing the same thing around this time, which is why Bitcoin is underperforming, which is also, why you have a lot of dispersion and underperformance in the industry overall. But it's also why I think that you have a lot more idiosyncratic things taking place in the industry overall. It's not all rising and falling together. You're seeing a lot more dispersion. Okay, with that being said, you can see that the IPO of Coinbase set the top for a while. And, Bitcoin is still around today. It's still doing fine. But the question is, do you want to have, if we have these frontier labs go IPO, could it set a top in markets that is pretty significant? And it overlaps with maybe some unlocks coming from SpaceX and some other things that really begin to unwind. And if that overlaps with any type of trade war, geopolitical risk, rare earth material kind of dynamics between the US and China, anything along those lines. The way that you want to be tracking that and expressing views is with, for me especially, is in single stock futures that are going to be on the CME and the futures that are there. Again, if you go to, here's the fact sheet that they have, it's going to be very helpful. They're going to have 55 single stocks with a 100x multiplier. And, if you go to that, there's still pending review and everything. But overall, think about that, 100x multiplier. That's massive. That's going to really change the game, because if you have an AI repricing, and hear me out on this, because the the I the pricing of AI is not about its adoption. People used the internet in the 2000s, and it was getting adopted by the underlying economy. But and I think that AI adoption is going to continue. There's no question about that. No one's saying that that's not going to happen. No one's saying that compute isn't going to continue and increase in demand. No one's saying that memory can't just keep increasing. What we're saying is that the pricing of it and macro liquidity around it can contract as we move through some of these catalysts. And that's really, especially if these frontier labs like OpenAI and Anthropic, what happens when they say, like, they set their date, right? I think this is what's going to happen. OpenAI and Anthropic are going to set their IPO dates, and we're going to start going into them because they bought, because they bought TBPN and some of these other like tech platforms and stuff like that. I think there's going to be a lot of narratives pushed for like basically being bullish into the OpenAI IPO. And, maybe it'll chop around for a little bit. Maybe it'll pull a SpaceX and bid and then sell off or whatever. We'll see what happens. But what I think is going to take place is either into it or right after it, you're going to have China have a coordinated economic warfare attack where they either launch models or kind of have a moment in financial markets, and guarantee you all the accounts that they've paid on Twitter or done stuff on Twitter with or whatever it might be, they're going to, begin to push those out and really try to create a narrative around that. And so I think that you have a really interesting situation taking place where if that begins to take place into that, you're going to have a winner take all effect, and they're basically going to do, this is like a global countrywide pump and dump, right? Everyone's seen it with meme coins right now, but the real pump and dumps that happen are on a global international basis between currencies and the economic warfare that takes place between them. So let's dig into this a little bit more, because I really want to jam through this slide deck and cover things a bit more. So the summit idea is that you have the US ascending with a lead in compute right now. They're leading the entire way. Chinese models have 40%, 46% of US enterprise usage. So they're chasing, but they're behind the US a little bit, but they're keeping pace. Once you have that dynamic take place, if China wins there, if they begin to change and win this prize of the winner take all effect for some of these models, that's going to begin to reverberate across the top 10 stocks in the S&P 500, which account for 41% of the returns. So this is one of the reasons why these factors are so important, because if you have a winner take all effect and China wins on that, which is, I was just watching this interview this morning with Alex Karp. I think he did a great job at explaining this entire dynamic. Let me find the interview really fast, because interview. Because it was a very kind of, I think, personalized and chill interview that was a good reflection of the ideas that are playing out right now. And I'm gonna put this in the chat, and then I'll also post this on Twitter just so that you guys can have it as well. All right. If you go to Twitter, I just posted it right here. You guys can like, retweet that, put your comments underneath about what you're thinking. But the S&P is very levered to this. On top of that, economic growth in the United States is very levered to this. And again, sure, there's still going to be a demand for compute, for data. This is why I'm not really worried about a lot of, a lot of names, because whether, you have open source or closed source model be the winner take all effect in markets, you still need compute. You still need GPUs. You still need data centers. That doesn't matter. That's like having the oil for the race car. We don't know which race car is going to win, but we do know that we need oil either way. And so that's why, I am very, everyone knows this. I'm very pro America. I'm very much believe that the best thing for the world overall is US dominance. I know that a lot of people don't really like that idea today because they kind of have been looking at all of the, misinterpreted negative side of things, and there's so much political polarization. But overall, and this is why we're going to cover this tomorrow, we're going to go over the US reindustrialization and why that's one of the best things for America and the US consumer, incomes, everything else. But I think it's very important that we win the AI arms race. However, from a market perspective, if you begin to have this escalation in the battle and you have these different changes with DeepSeek or the different US labs, that's going to move around markets significantly, which again goes back to why you really want to be connected to all of these changes in the CME contracts in single name stocks. Again, go to the single name stock webinar that's taking place by the CME. Again, this is right here. I'll retweet this, and you can go through all the single name stocks that are happening or that are getting launched by the CME group. Those are going to be things that I'm going to spend a lot more time trading. And if you want, all these names I'm going to have, and I'll be covering a lot more for paid subscribers in terms of analysis, positioning, fundamentals, and things like that. Because when you have this opportunity like this and this type of access for leverage, it just gives you a lot more opportunity. So that'll be something I'm focused on pretty closely in markets. And if you really want to dig into that more, I'll be covering it for paid subscribers. So coming back to this idea of the AI trade, because those are, all of these names, right? Micron, Microsoft, NVIDIA, the Chinese Internet ETF, TSMC, all of these names, if there's any type of escalation in geopolitics, for China or anything like that, it's going to be reflected in these stock prices. And I guarantee you, if there is going to be I've said this many times, if there is going to be any geopolitical risk or invasion risk for Taiwan, for China invading Taiwan, that's going to crash the entire U.S. stock market. Even if there's a risk, let's say China issues a threat that says, "Hey, you need to do this, or we're going to basically invade in the next whatever," right? With either all the new technology that they have or whatever it might be, right? If that happens, if there's any type of announcement around that, all of these stocks are just going to gap down, and they'll probably go limit down, like no question. If you have this rebalancing for the AI labs and a restructuring of things, that's also going to change a lot of the flows of capital. There's always going to be demand for chips and things like that, which is why people will probably get short a lot of the names and long others, which is why like NVIDIA is just kind of the king no matter what. It's also why I believe Oracle is going to do incredibly well regardless of OpenAI or Anthropic or whatever it might be. But look at this chart right here. You can see the memory side. You can see everything outperforming the China Internet ETF. And so the AI race is no longer just about a sector view. It is the load bearing column of US growth, equities, credit, and the dollar right now. So equities, top 10 names are a record of 41% of the S&P 500, 14 points above the 2000 peak. The AI beneficiaries drove roughly half of this year's index earning growth. This is key. I'll actually have a chart of that for paid subscribers later today. AI-linked debt of roughly 1.2 trillion just became the largest sector of investment grade bond index, passing the banks. So the thing that a lot of people have missed on the back end is that all these big banks are still floating they're all still floating all of these debt instruments, and they're incredibly significant for the amount of liquidity and money going into the underlying market. And so as long as that continues and the market digests it well, those are very bullish signals. So the trade kind of holding up everything with the dollar right now on a short-term basis, the credit market, the equity market, US growth, a lot of growth that's taken place has been connected to U.S. investment. We talked about this recently on the ISM, how construction spending, data center build-outs, a lot of material prices. I mean, we actually talked about this in the paid subscriber section recently. One of the things that James laid out incredibly well is just why copper is actually bidding and holding above these levels when gold and silver are kind of down here. And that there's upside in copper right now. So I think on a broad basis, there is just a lot of opportunity for how these metals are going to get priced and for capital to begin, hitting the entire power side, which is why the utility sector has, rallied so much. The industrial sector has rallied so much, and it's been incredibly elevated, even as the equal weighted index has pulled back a little bit, right? I mean, Qs have pulled back a little bit, right? We're kind of in this range right here, probably moving higher. But you have industrials holding and still above these levels. Oops, sorry. All of these things are very clear indications about how things are getting connected and more cross-collateralized with the AI trade. The index itself, again, S&P 500 versus equal weight. There's a reason why the top line index is outperforming. And again, this entire slide deck will be available afterward at capitalflowsresearch.com. You can go through it all yourself. So the AI trade quietly broke into 4 different trades, and most books still hedge it as one. So the foundry now moves. Let me kind of explain this. We have kind of the idea of the chip makers, the hyperscalers, and then you have all these kind of positioning. You have Korea, and then you also have the China part of the cycle. The idea here is that you have the hyperscalers, you have the power side, and you have China kind of in its own cycle. And now what people are doing is they're trading these dispersions against each other. So I put all the names here. You guys can go through these yourself. But if you want to go through the power names for the AI trade, they're all right here. If you want to go through the hyperscalers, they're all right here. By the way, I think that Microsoft right here is a really interesting, opportunity because it's kind of lagged behind everything. And I think it's a really interesting opportunity because if you have a bit more of a rotation for data, for the memory, for these other reasons, I think Microsoft is going to bid. Microsoft as a company is not going anywhere. People can float all these bearish narratives for whatever reason. But overall, I think that Microsoft is going to do incredibly well in this environment after they kind of adapt. But on the hyperscaler side, these hyperscalers are important to watch, especially as we go through these IPO markets. And then you have China in its own kind of cycle with everything. And again, we covered that. If you actually go to Capital Flows Research, this report that I did, could China crash the entire AI trade? I'm going to post this on Twitter right now. And if you guys can just retweet that so that everyone's aware, and then you guys can have it saved for later. Just bookmark it for later. Really go back and go through that and go through the slide deck for it, because the idea about China crashing the entire AI trade is linked with these ideas that I'm laying out. We did an entire thing on it. So I just posted that. If you guys can um, retweet that, that'd be super helpful. All right, let me pull this back up. All right, so these correlations we've already kind of talked about that are going to be really important to watch between power, China, and also hyperscalers and things like that. We already talked about the short-term changes between Nvidia, Micron, these catalysts with Cerebras and SK Hynix, all these different IPOs. The binding constraint migrates along the chain. So capital is moving from wafers to memory, then power, and the pricing power always lives at kind of these chokeholds of where things are. I'm not really the same, like a lot of people are talking about the bottlenecks and everything that's happening. What I would say is that all the same people are just betting on different parts of the stack at different times. And the the idea here is that here's kind of the capital stack. Capital is very abundant for anything with the AI trade. You have wafers; those are sold out. We already know that. Memory is pretty significant in how we go along the value chain. Then you have compute, which is going to be. I've talked about this. We're going to have compute futures launched on across a lot of platforms, but on the CME pretty soon. Let me go and pull this up really fast just so you can see this. Earlier this year, CME Group and Silicon Data partner to launch the first compute future. The idea here is that we're going to have derivatives around the entire GPU market. And this is going to determine a lot, which is, again, a reason why I'm, really, I think that the compute future launches that begin to come out so that you have GPU prices either for rents or for purchasing them. They become a place where people can hedge their risk. There's already so much money getting spent into these markets that the compute futures themselves are just going to be so massive. They're just going to be so much volume around them. So understanding compute futures is going to be really critical, and then we'll connect it to the power grid and everything else. But everything is lining up where you want to be watching all of these. And in truth, if there is some type of issue in some of these sections, it's going to, again, this is why the China aspect of it is so important, because if they really target certain elements, I mean, the biggest vulnerability for China is their lack of chips, but they have a lot of power and electricity, more than the United States right now. But in terms of the intelligence of the frontier labs, intelligence, open source models, and things like that, it's significantly higher than the U.S. right now. And so I think that we need to see that this is why the frontier labs in the United States are getting pushed into this corner. And I think it's going to be really interesting to watch how, if we have geopolitical risk, every semiconductor PM, portfolio manager, trader, whatever it might be, they're going to be watching how all of these changes in the software space between these frontier labs and the Chinese names, as more IPOs over there as well, how they all are maneuvering through this market, because it's going to be really significant. All right, I'm going to go through a couple of these a little bit faster. And again, this entire slide deck will be available afterward. Here's a breakdown of forward earning multiples versus operating margin, so you can kind of see where we're at. Where operating margin being higher, that's why SK Hynix, you have it rallying so much on the day today. I mean, it's up. We're up 24%, guys. This is not what you have when you're having liquidity contract in the market. When you have an IPO, you flush some of the positioning, and now you have 61 million shares going through on the day. That's $189, and it's up 24%. I mean, those are significant numbers. That's a lot of money. So, you know, here, pull this up. Here you can kind of see how, Nvidia is kind of on the far end of this curve in terms of valuation. Palantir is all the way over here. Intel is all the way over here as well, but I think Palantir, really interesting to see how aggressively priced the market is for the PE. But I think there's an element for that because they have a monopoly on a lot of things. If you go to the Palantir chart, and this is going to be, again, we're going to have single stock futures from the CME on this pretty soon. I think the opportunity is going to be, there's going to be a moment where if you have any issue in some of these frontier labs or something like that, or if you have any issues geopolitically, it's going to just push more people to Palantir. That's my view. And that's why I think a lot of the defense contractors, Palantir is just taking so much of the market share for government contracts because they have a monopoly and they have, I think, again, this goes back to the interview I just mentioned where, let's see, where Alex Karp is talking about how Europe, the war in Ukraine or whatever that might, or any of the conflicts that have taken place would not have played out the way that they are if Palantir and AI were not present there. I think that one of the things that he said that was really interesting was that the Ukraine, the war between Russia and Ukraine, Ukraine would be gone already if it wasn't for the technology and the AI technology of Palantir, which I think is really interesting. So again, you can have your views on if you think that should be happening or not. What we do know is that Palantir is being used by a lot of major governments in the world, a lot of major corporations in the world. Obviously, there's a focus on U.S. dominance that Alex Karp is very clear about. And I think that there's a reason why I think Sam Altman and Dario are so focused on this narrative that AI could destroy the job market or something like that, because I don't think they want to address, I think they would rather fearmonger than address why they are not partnering more aggressively with the United States because of the significance of all the AI labs and how significant they are in a geopolitical context. And I think that as we get more and more connected in these AI labs to the retooling of the U.S. economy. I mean, the amount of people I know now who are providing e-commerce and marketing services with AI is like insane. It's like Facebook ads in 2016. It's like insane. So many people are now using the entire AI play to make tons of money and retool everyone's businesses around AI. And I think that's great, by the way. I think it's probably one of the best opportunities that exists in the market. If you can come into a corporation or a business, especially a small local business that has an edge in relationships and help it, that's amazing. It's amazing. So the build out and everything right now is on borrowed money, right? We have $1.2 trillion in investment grade bonds that have been issued, 32 billion of high yield bonds, and 800 billion in private credit. And all of that is going into these build outs. And right now we don't have the returns, which is fine. There's nothing wrong with that. However, if the market is expecting returns within 6 or 12 months, and that's not a realistic time horizon, and it gets pushed out, and we don't have liquidity increase in financial markets or deregulation happen, or the government, the U.S. government nationalize any of the frontier labs or anything like that, then that's just the timing of it could get repriced. We're not saying they're going to default. We're just saying the timing could get kick the can down the road a little bit, and it could cause a pullback in equities. We're not there yet because we're still seeing these IPOs come out, and we're still seeing all these changes that are pretty significant on the liquidity side. So, I'm still bullish for a reason. There's a reason why high yield spreads are at cycle lows right now because there's a very significant amount of money in the system. So uh, I'm gonna kind of jam through the rest of these slides. You'll get this entire slide deck afterward. You can go through all of these ideas, but let me pull up this. I'm trying to find this one chart. I think I skipped it. Here we go. Let me just close and cover with this right here, and we'll go over a couple more ideas. But my view is that America holds the high ground right now. China floods the low ground, and the tide caps everyone's pricing power. So the implication of this, all this means, is that when you have so many smart people working on all of these different AI plays at the same time, it begins to commoditize things. And I think that a lot of these chips, a lot of these, especially open versus closed source models and things like that, we're already seeing them, lose market share edge because things are moving so fast. I think one of the great sections in the Book of Elon, if you guys haven't read that yet, I forget what the guy's name is. Just look at Book of Elon. One of the things that he talks about of an edge is edge in a company is the speed at which you can iterate. When I talk with people and they're like moving really slow through life, like that is like a signal of someone just waiting to get disrupted or to just be disappointed because the world is changing really fast. If you can't iterate incredibly fast through things and like whatever it might be, if you're investing in a company, if you're trying to get a job, if you're trying to find a certain stock or investment or trade, or you're build some type of partnership or relationship, you need to be able to iterate so fast because things are changing so fast. The opportunity cost in today's market is so high that being able to iterate incredibly fast is just is one of the biggest edges that you can have. So, excuse me. So coming back to what I've laid out today, we know that the U.S. and AI side, the U.S. and China side for the AI trade is becoming an asymmetrical linchpin. We know that for me, I'm going to be focusing a lot on these single stock futures from the CME. Again, go to the webinar that they're going to launch and be able to get an insight on just what's happening. You want to get prepared for any derivatives that are getting launched. Go through the Alex Karp interview that I just mentioned. Download these charts on the IPO market and the value of them. And keep an eye on interest rates because we'll cover this more in the paid subscriber section. But especially post the CPI print and the warish news and everything like that, we're going to cover that in a moment in the paid subscriber section. My view is that the macro drivers overall and the AI drivers overall are still intact, but are becoming increasingly fragile. And the tails are compressing in the market, which just means that in the overall system as a whole, smaller and smaller things can cause larger and larger moves on the upside and the downside. And my view is that active management in today's world is the biggest edge that you can have. Active management that just iterates at such a high pace, a high degree of speed, is so critical because the world is changing so fast and the tails are compressing. When I say tails compressing, all I mean is that the entire world is getting retooled so that very small things can have a very large impact and retool the entire system and change everything. And so I'm going to cover that more in the private members section, which will just be on Substack. And then I'll have a report on there as well for all of you guys. If you guys haven't gone through everything that we're going through the private members live stream, I'd encourage you guys, you can do a free trial. You can go through and check everything out for this week, which is going to be really critical um, on the U.S. exceptionals and trade, the other things that we're thinking about within that, and then we'll do a live Q&A there. You'll have the report that is linked there afterward. You'll get the entire recording of the session if you can't make the entire thing, but everything will be laid out further in the private members section. I hope that spend some time going through these different ideas, mapping these flows, go through the slide deck. The slide deck will be available afterward, and spend time thinking through how these factors are pushing around the flows of capital. These IPOs are setting levels in the index. These are all very important things to think about. So we're going to dig into those even more in the paid subscriber section. So we will take a short break, and then I will catch you guys back over on the private members live stream side. So with that, I will chat with you guys in just a moment on the other side.